So what is going on today? Let's take a look. Yeah. Well, the S&P is having a nice day. We're up 0.73 on the S&P. We are up 1.3% on the NASDAQ, just going to the moon with no stops. Russell's kind of flat. Dow up 100 is practically flat for the Dow. You know, I mean, especially on the Dow, you're going to notice this, but the higher it goes, the higher it has to go all the time. So now we're getting near Dow 40,000. That means a 200-point move is only 0.5%. So you're going to have like constant 200-point moves. It's going to seem crazy because our mind is so fixated on a 200-point move being a big move, but it really isn't. I mean, a 100-point move is nothing now. It's 0.25%. You have to adjust your expectations accordingly. So we shall see. Oh, and even as I speak, things are going lower. Oh, well, so much for that. In other news, oil got a bump off the EIA report, which is better than the API report. So people are punching it back up. It's a little too scary to short though right now. We'll go over that report in a minute. Natural gas came back up nicely from this really bad low. It was down to 230 practically. Gold is still hovering over 2,000. Silver still going up, although the long we wanted to do earlier didn't work. It didn't really break up from 23. It went back down, but now it's heading back to 23 again. I'm all for playing silver over 23, but with tight stops. Now earlier we played oil first thing in the morning, and we shorted it at 75, and we got this nice little dip back to 74.50. So that was good for $500 real quick first thing in the morning. But you know, you gotta not be greedy. You have to go into it and say, I'm just happy to make $500. I'm gonna be very happy. What Wednesday was that? That wasn't this Wednesday. All right, let's go back to the main page. I can't get back to 400,000 followers. I gotta do something to get some more Twitter followers. Retweet me, please. I need more followers. It's annoying. It's annoying that I'm under 400,000. I used to have 1 million, but then it turned out a lot of them were bots or something, and Twitter did a purge. They purged everybody, and my subscriber count went down, but it's held steady at 400,000 since, so that's good. Let's see where we are today. Okay, so today we talked about, we're talking about China a lot because China's in, I mean, China is, forget the market size because their market is screwed. Their market's down 40%, but that's the Hang Seng. And that's the PE ratio of the Hang Seng also. It used to be at 22.5, which is comparable to the S&P. Now it's at like 7.5. The average stock on the Hang Seng is 7.5 times earnings because nobody has faith in Chinese economy. It's a big problem. And this all started really, we were talking about getting back into Alibaba again. And Alibaba's having a good day there. This all started when Jack Ma, we weren't paying attention because of COVID, but there was COVID, and during COVID, China really dropped the hammer on anybody who was critical of the government. So Jack Ma from Alibaba was one of the guys who was very critical of the Chinese government and saying they were stifling innovation and blah blah blah, and he couldn't compete evenly with Amazon and such because he had to follow all these rules and report to the party and ask permission to everything. Meanwhile Bezos is building rocket ships and doing whatever the frick he wants. It's all a different ballgame. If Amazon wants to buy UPS, they buy UPS. But they buy Whole Foods. They did buy Whole Foods. They pretty much do whatever they want. China purged a lot of these guys, and Jack Ma like disappeared for a while during COVID, and he was sent to probably some sort of re-education center to learn how to be a better communist. So, but I think that that's past them. But that was this huge decline in Alibaba and the Hang Seng. It all came around at the same time. Alibaba was a leading stock on the Hang Seng. So, people saw that happening. You lose faith in, if they're going to start like picking up business leaders off the street and your CEO disappears randomly. It's kind of hard to invest in companies like that. So that's the situation we've had in China, and the COVID was terrible for them. Of course, they spent massive amounts of money themselves on stimulus and so on and so forth. They're having a hard time getting their economy back up and running again, and civil unrest, strife, high youth unemployment, all sorts of problems over in China. But it's still a huge part of the global economy, and I mean, it's hard to say what their real economy is. Their GDP is at least half of ours, and very possibly 3/4 of ours. And that puts them head and shoulders above any other single country's GDP. Europe is a bloc. The EU is right behind us on GDP, which ours is about 25 trillion now. China's got to be at 12 trillion, 13 trillion, and possibly at 18 to 20 trillion range. It's very hard to tell because they don't keep the same kind of numbers we do. You can't trust their numbers, etc. But still major economy, still growing at a rate that's faster than we're growing, frankly. They still have better growth than we do. So and these companies like Alibaba and like JD are growing outside of China. 1/3 of both of their businesses outside of China. And that then takes away part of the risk of them being a Chinese company as they get bigger and bigger outside of China. I wouldn't, it would be difficult, but at some point they could relocate and just get out. That would be a huge bump in their multiples that they get. But it's all based on a lot of negativity, and most of it's baked in. And now the tipping point, because we've been watching them for a while, and I've said over and over again, I said, Alibaba, but we got so burned on China Telecom, CHL, I think it was China Telecom. They got delisted in the U.S. and it became an untradeable thing. We got, it was complicated to get out of them, but we just dumped out of our shares. But we took a loss, and the stock went down. It was a nightmare, and we were stuck with the stupid shares. It was a real pain in the ass to unload them. So for the portfolio purposes, I didn't want to get back into the Chinese stocks really. If Trump comes back, we probably have to get out of him again because you don't know what that guy's going to do. But as it stands now, we're pretty stable. We're kind of stable with China as far as the relationship goes, unless they go invade Taiwan, which will be a big problem. And I don't think they really have the strength for a fight right now. But I don't think they're up for it. And the other thing is, we seem to be in a sort of detente as far as all this tit for tat, and tariff stuff, and the government of China is of course starting their stimulus. In fact, from yesterday to today, they announced that they would be. Well, they didn't announce. There's rumors being floated that they'll do stimulus, which is usually, since the rumors come out of the Chinese government papers, it's usually more than a rumor. They're just sort of gauging people's reaction to it. And they're saying they're going to do some stimulus, about $300 billion worth, which is a nice amount, but nothing compared to what we do when we drop stimulus. And of course, then it depends on how they give it out and if they do it the right way and what the effect is. But we'll see. But anyway, so the bottom line is I don't want to miss out. I'd hate to see Alibaba do this. I'd hate to see it go for like bip, bip, bip and go up, or well, this one went back down. But I'd hate to see, yeah. I'd hate to see it do this, and then we kind of regret that we never got on board, and then it's too late, and then we're like, should we got in? No, we shouldn't. We're talking $75, and it's about 7 times earnings. So, you know, it's very, very cheap. And could it go to 5? Yeah, but if it goes to 5, unless we were like at war with China, I think I'd still want to buy more. And the same goes for JB. So we sent out, so we talked about that. You know, here's the entire FXI from 50 to 22. You know, that's 60%. You know, 50 to 20 is 60%. That's as bad as what happened to us in 2008, right? That was our lows was about 60% off the top. It's hard for a market to get much lower than that because it gets ridiculous. And when our market was at, oh, let's see, what is this? Capital gain tax, don't care. Okay. PhilStockWorld.com, worst case scenario GDP, I think is what the article was about. Ah, that's amazing. Google is amazing. I don't understand why Bard is so bad when Google is so good. That's what drives me crazy. So here's the stock I wrote in 2010. And the article was the worst case scenario getting real with the global GDP. And I said 10,500, that's a per capita GDP average of 6 billion people on the planet. There are now 8 billion people on the planet. So in what's how many years? 15 years? 14 years? 2 billion more people. So the GDP for every single person on the planet is $10,500 out of the global economy. So, you know, I talked about what the reality is, and most of those people I said are still farming. You know, you think of the people, like you see these pictures of people carrying water on their heads. You know, they still do that. They still follow. In China, there's people following oxen and bending down all day long to pick rice out of the water in the fields. You know, this is, you know, a good portion of the global, you know, probably about a quarter of the people in the world are still farming. So when you talk about our GDP is $46,000, and I talked about that, I said, you know, if you wiped out the entire Western world, then the global GDP would still be around $6,000 a person, which is what, you know, which is where China is. So, you know, China's at 6,000, India's people are at 29. So 20, I figured 29 would be the worst, right? That's what I said. So I said, let's say we all end up around India's level of economic prospects. You take that number and you multiply it by 6 billion people, and you're still getting whatever it was. I forget the number. It's math. Let's see what it is. Too big of a number for me to think about. It's going to be 3,000 times 6 billion. Well, there you go. It's going to be 18 billion. So the total GDP would be 18 billion in a complete disaster where the whole world was wiped out down to India's level. And if you think about that, and you look at it and say, well, and how long would that last before we rebuilt things or did whatever? You know, this is when we thought the banks were all going to collapse and everything was over and the West and the economy was going to fail. I said, look, realistically, even if you go down to 2/3, which is where the market was, and that was the point, the market was down 2/3. It was pricing in an $18 trillion GDP for the planet. Now it's $100 trillion. Back then it was like 60 trillion for the planet. That's your worst case. So when the market drops 66%, when the market drops 2/3, you've got to be at a bottom because it's stupid. You know, and of course, individual stocks may not work, individual companies may go bankrupt, but as a concept, you're still going to wake up in the morning and you're going to have to find some food for your family, and you're going to have to get some clothes, and you're going to want a mode of transportation, even if it's an ox, whatever you end up looking for. There's a limit to how low things are going to go, because people are going to be people, and we're going to feed ourselves. We're going to have children. We're going to want to do things. We want to pursue activities. We will trade and barter and so on and so forth. There will be an economy. There won't be no economy. And when the market drops 60%, you're pretty much saying that your economy is now dead and won't recover. And that's nonsense. Now, it's possible that your economy was completely false in the beginning, but it isn't completely false. It may have been exaggerated. We had our banking crisis, and a lot of the profits that the banks were booking were fake, based on bullshit valuations of mortgages, and the mortgage companies had fake things, and the real estate companies were making commission off of transactions that were hugely inflated, blah blah blah. So we were never going to get back, and we are back to it now, but at the time it was like, well, we're never going to go back to that top, but we sure as hell shouldn't be this far down. And somewhere in the middle is the truth. But the thing is, if somewhere in the middle of $6 trillion to $2 trillion of a sounds like 60 to 30 trillion. If somewhere in the middle of $60 trillion to $20 trillion of GDP is the truth, then $25 trillion for a global economy would be up 25% from where you are. And that's when you say, oh, okay, so if I'm, let's say the banking system was completely wiped out and everything was gone, and you wake up tomorrow and your job is gone, and the electricity is off, and there's no this and no that and whatever, what are you going to do? Well, first of all, you're going to go find some food. You're going to get some water. At some point, you're going to need a doctor. You're going to want some shoes of some sort. All right, so then you start thinking about the companies that might still be around to provide that stuff. And that, and again, and those companies are going to go, like, so let's say Crocs, okay, for example, Crocs needs rubber. So will they still be able to get rubber to make their shoes? Will they be able to get it across the ocean? Will there still be ocean liners? Will there still be fuel for them? So on and so forth. But, we traded with China 600 years ago. So yeah, we'll be able to get stuff from other countries and bring it over here. Look at Marco Polo. He did it on a horse. And people did it by sea, and that's what Columbus was doing in 1492. He was looking for a better trade route so that he could trade with India more efficiently than going overland. So, you have to think about the world like that at a base level and be like, you're going to wake up after the apocalypse and you're still going to want to get a meal and wear some clothing and have some footwear and have some transportation. And you think down the line is like, well, how's that going to work? Well, worst comes to worst, we have cotton in the United States and people know how to sew. And if you think about it, then so a company like Levi's would be one of the likely ones to be able to say, okay, well, we lost all of our electricity, but we could still hire people who know how to sew and put clothing together, and we understand the business, so we'll become a handmade clothing manufacturer or whatever. And of course, that's ridiculous. That's not going to happen. We're not going to lose the knowledge of how to produce things or whatever. Just because the monetary system collapses doesn't mean we lose our technology. It might be more difficult to do something with it. It might be difficult to do trade, but it would get figured out at some point. And that means that when you talk about a market dropping 60% due to a crisis like COVID, due to a crisis like the 2008 financial crisis, you have to step back and say, well, that's kind of stupid. And that's where we are with these Chinese stocks right now, okay? It's like the Chinese economy is not going to zero. These, now, how well will these companies function? Will the state do whatever? Will the Chinese government do this? Will the people do that? Will there be a depression? It doesn't matter. If you're a long-term investor, you say, hey, these companies have tremendous, it's like Amazon, okay? It's like, will Amazon go out of business just because we have a recession? No. They might have to reorganize, they might take some losses, blah, 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 but still they're endemic. They're everywhere. They're going to be very hard to get rid of. And they're adaptable. They've proven that they're adaptable and they can survive, you know, shocks and so on and so forth. So, you know, that's what this article was about. I was talking, in fact, further down the article, I think, and talk about what companies. Yeah, I talked about, you know, I said we're still going to fly in planes. We're still going to use the web, which is Cisco. We're still going to make phone calls, AT&T. We're still going to buy homes and we need to fix them up with Home Depot. We're still going to take our pills when we get sick, which is Merck and Pfizer. You know, there's basic things that are going to go on. And I said even Nicaragua, which has a GDP of $2,600 per person, has 30 Walmarts. With a GDP of $2,600 per person, Walmart is thriving in Nicaragua. You know, I said, will we give up Coca-Cola? We'll give up AA. Isn't that Cola? What the hell was AA? That's weird. Oh yeah, aluminum cans. That's why. I'm like, why would I have written AA? So yeah, it's like, well, we go so to say, you look at Coca-Cola, you think about aluminum cans, Disney, Hewlett-Packard, IBM, Intel. Now, keep in mind, I was pointing this out when these stocks were down 2/3, but I don't even know what they were by compared to what. But I mean, I know Apple was like, you know, $7.50 before, you know, pre-split at the time. So it was 75. It was 750. It was 750, but it was 75. But then they split 10 for 1 along the way. So basically, Apple was at $7.50 at the time. That's how cheap things were. Bank of America was our trade of the year in 2010, and it was our first trade of the year. It was 2010, and Bank of America was $5 when we jumped into it. So I mean, these things are up 10 times now. But I'm thinking, are we going to stop using fertilizer? Are we stop going to farm? DuPont, Monsanto, Caterpillar, UTX. Are we going to, you know, will buildings still have elevators? Then Otis Elevator should do well. They split that out actually in the end. Microsoft, of course, you know, we're going to have computers, we're going to have software, we're going to need fuel. I said I said even if we write off Dow Components, Bank of America, and JP Morgan, GE will likely survive, which they did, and 3M did well. Travelers Insurance did well because people still need insurance. When you loan somebody money, you demand that they have insurance on the product for the transaction. That's your collateral, right? You want your collateral to be insured. That's how transactions work. That's not going to change. So these were sort of examples of what we were talking about at the time. And that's kind of where we are in China. It's so low now. China has gotten so sold off, and you don't count it from the top, really. You count it from where it is here, but it's still 50% off the midpoint. And this is since 2012. The midpoint has been about 40. And now you can buy it for 20. We're getting to a point where we're close to a bottom. So, and I'm not saying buy any random crap Chinese stocks. Certainly don't buy the Chinese commercial real estate that's really dragging them down here. A lot of these real estate companies, a lot of these big real estate companies have gone to zero, and probably should be less than zero at this point because they're old debts. But that doesn't apply to JD. If you look at JD, where is this? Stockopedia. So here's JD.com. 34 billion. This is correct in dollars, okay? But when you look at the net debt, that's in yuan, but it still comes out to like 20-something billion dollars in cash net of debt. Don't pay attention to TTM. So it's that much in cash net of debt, which is unbelievable. And look how it piles up. It just piles up and piles up. They're like Apple practically. Just money just keeps pouring in. There's negative debt. And they got these fixed assets too. So they've got all kinds of stuff. Their book value's flying up. And that's crazy because they're being sold for $34 billion. So great growth, no debt, lots of cash. Why would you not want this company? It's stupidly priced. Even what's his face agreed? Bing, Shellbot. So we asked him later. Wait a minute. Control F, JD. Yeah. So I had Shellbot do an investor analysis, and he said, where was it? No, Baba. No, not Baba. No, it was JD. Oh, here you go. I agree with Phil's comment that JD's valuation is stupidly low. That's an AI telling you this. And the company has $25 billion in net cash, which gives it a financial cushion and flexibility to weather the storm. The company also has competitive edge in logistics. It covers 99% of, so they're basically like UPS. They're like Amazon, UPS, whatever. They sell their services, their logistics services, to other retailers. So retailers use them to distribute their products all over China. And China is very rural in a lot of places. So, I like JD a lot as a play. In fact, I sent that out as a top trade alert earlier because it's got a more sure thing. Even though the CEO of JD has been accused of like sexual harassment or something like that in the US. So he's got his own problems, but it's not as bad. Sexual harassment in the US, as you can see from Donald Trump, is nowhere near as bad as as pissing off the Communist Party in China. So, that's the problem with Alibaba, is that there is that still risk that they don't like Jack Ma, and maybe they're not 100% happy with him anymore. Jack Ma really shut the hell up, right? He used to be all over the place. He hasn't said a word since. He does not say boo. That is some good re-education they got over there. That'd be great if we could do that with our politicians or business people. Send them off to re-education camps. So this is the trade we set up for JD, and so they're at $23. We're buying the $15 calls. We're selling the $30 calls. So that means that we're $8 in the money. So 40 times 8 is $32,000 in the money, and we're paying $12,550 for the spread. We're selling 20 puts at 25, which is higher than it is now, but we're selling them for $690. So the net of the put is what are they? The 25. Oh, I didn't put the dollar sign. So it's 25 minus 6.9. So it's 1810. So we're net 1810. So this is just a way to raise cash by making a commitment to buy 2,000 shares for 1810, which is $36,000 plus dollars, whatever it is. So we're willing to buy $36,000 worth of JD, and we're being given $13,800 to make that promise. So that's free cash. We put that cash towards this play, and if it comes out below, if it's below 27, if it's down to 1810, all that does is wipe out this cash that we took in. We have to give it back. But above 1810, we keep some portion of this cash. Meanwhile, the spread is net 6, and it's a $15 spread. So if we're over $21, we're going to be making money for sure, because it's over 21 is over 1810, and it's over the break even here. So that's all we need really. It's about $20, $21, and we're good on this trade as far as a profit. But the really good news is all we have to do is go to 30, which is here. Forget the 30 is 7. Let's say 30%. So forget 30 is 30% higher than 23, because this is probably an overshoot. Look how we tried to get back over 23 and kind of jittering under it. Once we break over 30, and if we can form a base down here, we should be in great shape. And we're in great shape to make 378%. So, break it down. What are we promising to do? We're promising on one part of the trade, we're promising to buy JD for 18.10, which is significantly below where it is now. Basically 30% below where it is now. On the other hand, we are taking this spread for net 6, a little more than net 6 because we have 5 open, but we're taking the $6, we're paying $6 for the $15 spreads. So even if they just pay out by themselves, even if you don't do the puts, you're still going to make 150% at 30. And the spread at 23, even if you just look at this spread straight up and you say it's 6 times 40 is $24,000, right? This spread at 23 is $32,000 in the money. It's a $24,000 spread. Again, if you had 40-40 here, it'd be a $24,000 spread. That's $32,000 in the money. You're 50% plus in the money to start the trade. This is just window dressing on it, but we're comfortable enough that this is a stupidly low price and there's no reason not to be aggressive on the short puts, which then lowers our cost basis. And again, that makes sense when you have a portfolio margin account, right? Because in a portfolio margin account, you only get charged a couple of $1,000s in margin for this. So why should I use my cash up? If I can get $13,800 and be charged $2,000 in margin, why not? So that's how we set up that trade. The other trade with Alibaba is a little more aggressive, but more chancy. But in Alibaba's case, we went up. Wow, that's weird. Twice in a row I did that, huh? We sold 65 puts, which are below the current price. So I gave us some leeway. And we sold the 65 puts for 10, but still that's net 55 and we're at 75. So 30% discount basically if we get assigned. Then we took the 70s, which are in the money, but not as much as the JD. We took the $70 calls and sold the $100 calls, and that's 10 on a $30 spread. So there you can make 200% if we get to 100. And again, it's not about whether 100 is 30% more than 75. It's about that 100 is not really a lot to ask given where the stock has been. So, China with some stimulus and some business friendliness. And by the way, that's also the logic is it doesn't seem to me that the government of China is going to shoot themselves in the foot and hamper these tech companies that lead their market. They know they're not stupid. They want to rescue the economy. If you want to rescue the economy, you've got to let these tech companies do their thing. They have to pull back on that. And it's a soft retreat for them. It's not like they have to run policy decisions. It's just the way the government decides to crack down or not crack down on a sector. And it doesn't, as they've now figured out, it doesn't matter what they do to real estate, it's not going to be fixed. So they're trying to move the economy away from real estate, which is about 1/3 of their total economy, and they want it to go to other places. And where better than big tech companies like these guys? So and of course, obviously, it's just like Amazon. It's like any change of commerce, any positive movement in the commerce of the country is going to be good for these guys. Any additional money being put in, more money going to workers, getting the youth to work, everything these guys want to do falls back to this stuff. So Alibaba, we had a net $10,000, but it's a $60,000 spread. So we have a $50,000, 500% upside potential at 100. And we're starting out in this case, we're 10,000 in the money to start out. So we're certainly getting our $10,000 worth, right? We're laying out 10,000 in cash for a spread that's $10,000 in the money. And every penny, since we have in this case, the puts are lower than the spread, every penny it goes up, we make money. It just puts us more and more in the money. It doesn't matter what it is. We're starting out at the money at $10,000. Anything over 75 bucks, profit for us. So, this is how you use options to substantially lower the amount of money you have to lay out for a trade and substantially raise. Like, in other words, I don't have to buy. How would I make $50,000 on Alibaba if I bought the stock? Well, it's at 75. Let's say my target is 100 even. So to make $50,000, I would need 2,000 shares. I'd need 2,000 shares to go up 25 bucks. 2,000 shares of Alibaba cost me $150,000. I'm using $10,000 to make the same amount of money. And now so obviously, I mean, not even a question that you're getting incredible upside leverage, right? So what happens if it drops $25? Well, $50, this goes worthless, and I would then owe $15. So at $50, I would lose $50,000 here, right? It would be the same $50,000 I was trying to gain, I would lose if it drops down to 50. Okay, so over here, I would, then you're down on the stock, straight stock, you're down $50,000. On the options, this bull call spread goes worthless, and it wouldn't really go totally worthless, but for simplicity's sake. And the $65 puts would be $15 in the money, and we've got 1,000 of them. So we have 1,000. Well, this is obviously easy. 1,000 times $15 loss is $15,000. So on the way up, I make the same $50,000 by laying out $10,000 on the way up. On the way down, instead of losing $50,000, I lose $10,000. I'm sorry, I lose $15,000. So I lose less money on the way down. I make more money on the way up. Now, I cap my gain because it doesn't matter if it goes to 100 or 500, I'm still going to make the same 50,000 bucks. I've capped my gain by selling these calls. Although, again, our longer time members know that we can adjust that also and actually improve it. But for some, for the sake of this actual spread, the way it's laid out now, that's how it is. So I've capped my gains, but my chance of success is much, much higher. And this goes back to something I talk about a lot. It's like, it's like I'd rather be Ty Cobb than, I'm not going to say Babe Ruth, or than Hank Aaron, let's say, because, frankly, Babe Ruth was almost as good of a hitter as Ty Cobb as far as batting average, but he also hit him out of the park. But Ty Cobb, the all-time leader, batted .467. He got a hit almost half the time he got a bat. No, not 467, 367. I'm sorry, 367. It's 1/3, not a half. That would be silly. His on-base percentage was probably half, but let's not get technical. But anyway, so he would get a hit 1 out of 3 times. He would get a hit. Babe Ruth also got a hit 1 out of 3 times, but they were bigger hits. All right, Hank Aaron, much less. Still phenomenal, great player, all that. But the question is, are you going to go for the singles or are you going to go for the home runs? And you're better off with a higher winning percentage. You're better off having a small win and a small win and a small win than a win, win, loss, win. If you can just string the wins together, the math takes care of itself. Everybody scores, just like in baseball, right? If everybody gets a single, if all 9 batters get a single, that's great. But if instead you get bases loaded and a guy strikes out, and then the next guy hits a pop fly out, and then maybe a run scores, and then maybe another guy grounds out, and that's the end of the inning, you only scored 1 or 2 runs because people who struck out or got out didn't advance the runners. Whereas if everybody just hits a single, 1, 1, 1, 1, then you have 9 guys hitting singles, and that means 6 runs scored because there's 3 guys on base and 6 runs scored. You make much more money just putting together a bunch of successful plays. So we go for the higher percentage plays. We go for, as you can see, we can make 50,000, but we're only going to lose 15. And again, it's not only, anything could happen. But what we do know for sure is we can't make more than 50,000, but we're probably not going to lose much more than 15. Chances are we can stop our losses before it gets worse than that. And that's the secret to success. Keep your risk-reward ratios in line. Make sure you have a much higher chance of winning than you do of losing. And even if you're only right half the time, you will make money. If you're getting paid 2 to 1 and you're right half the time, you're going to do very well. And that's what this is. We get paid 50,000 for being right. We lose 15,000 for being wrong. Call it a stop, if you will. And all we have to do there is, if we lose twice, we lose 30,000. If we win once, we win 50,000. We're net 20,000 ahead, even though we were wrong 2 out of 3 times. And that's all it is. That's all your money management is. It's portion control. You know, in the long-term portfolio, we always talk about our allocations. And when we have a $1 million portfolio, we generally want to have, we want to have 20 allocation blocks. So we're going to have 20 open allocation blocks at any given time. Those allocation blocks are going to be, we have 2 million in buying power. If we have $1 million, we have 2 million in buying power, right? In ordinary margin. And of course, with portfolio margin, you have much more than that, but you don't want to use it. You know, you want to use it for sensible things, but you don't want to use it like on a regular basis. That's how people get in trouble. But you set up, let's say, an ordinary margin. You say, okay, I got $2 million to spend. I'm going to take 20 positions. And that means you've got $100,000 available for each position in total margin and cash and margin use. That's how we like to start. Then once the position's settled down, we can add more, because we look at a position, and I'll show you how. Let's take a look at the, oh, where's that thing? Power options. So we go to our long-term portfolio, which is probably doing well. Yep. No, that's a short-term, dummy. Long-term. Oh, fell under $1 million. Oh, well. But anyway, we go to our long-term portfolio. And when I talk about an allocation block, that's your commitment. So JP Morgan doesn't have any puts. So we've tied up 13,000 in cash. And so we have $100,000 allocation blocks. We tied up 13,000 in cash. That's using very, very little. So we can easily add on to this trade if there's anything wrong with it, whatever. Here, we sold the $100 puts, and we sold 10 of them. So here we tied up $100,000. You know, we've tied up $100,000, but if we get assigned the stock, we'll only be charged $50,000 in margin, right? So we're at $50,000 really for margin allocation on that trade. But it's so far in the money that I would not count that as being an allocation use, because it's almost ridiculous to think that it's going to go all the way down to 100. Cheesecake Factory, if it goes badly, we'll have $30,000 here that we're using up. This one would be $100,000 on GNRC, but it's a $100 put there at 114. I feel good about that one. Levi's, 25 times 12, whatever that is, $30,000, $40,000 is what would be allocated, but that's a $12 put. The stock's at 15. So none of these I would be setting aside a lot of margin for, because it doesn't seem necessary. Any of the other ones bigger? No, it's all the same, 30, 40, whatever. But meanwhile, what happened is we sold them for 15, 36, 46, 50, 37, 42, 62, and 11, 63, 60, 73. So we collected $73,000, and most of these, even this one, even MP, which is showing a loss, I mean, it's at 16 and it's a 1250 put. It is silly. How does this count as losing money? RH is a risky one. Also still the same $100,000. So you can see where we keep our allocations around the same. And RH is at 271. We have 250 puts also looking good. Even though it shows negative now, we're in good shape. So we collected $75,000, and if all goes well, and all of these are above their strike price, if all goes well, we'll keep the $75,000. And none of these are considered dangerous enough that I would set aside much of an allocation for it. So we have that. Oh, here's this RH is part of a bigger spread, actually. So RH, we have the 260, 300, and we're kind of on track for that. That's in good shape. Also showing a small loss at the moment. With Apple, we have only 5 puts, so we're only risking, is that $80,000? Yeah, 80. So we're risking we're risking owning $80,000 worth of Apple, which frankly I don't consider a risk at all, and we own it at 160. So that's that spread. So that's our risk. We've got the cash is already taken out. So what's our risk that we've allocated to this thing? So our risk here, and our risk, by the way, that's also, our risk isn't $80,000. Our risk is because Apple's not going to go to zero. You know, you have to apply some sort of logic to what you're doing. And also we hedge, that's a whole separate subject. But Apple's not going to zero. So I'm not going to sit there and allocate $80,000 to Apple just because I sold 5 160 puts. I don't for a second believe Apple's going to go below 120. That would be crazy. So even if Apple goes to 120, what am I losing? I'm losing 5 times 40, which is $20,000. So I would allocate to this trade $20,000, not $80,000. So this spread is using $20,000 of my buying power. ACAM, so on and so forth. You have to go through each one and figure out how much of your buying power is being used. But you don't just, you know, the worst case end of the world scenario. But really, if Apple goes to zero, all right, look at Boeing. Boeing could go to zero. Boeing can go bankrupt if their planes turn out to be completely lemons and they have to scrap everything and everybody cancels their orders. It could happen. It's not likely, but it could happen. But it's much less likely that Apple, I mean, I guess their iPhones could explode. The new iPhones could like explode and cause thousands of, it's funny because it's so widely distributed that they literally could, if they had exploding phones, 1 million homes could be destroyed by exploding Apple products. But unless something insane happens like that, and of course, obviously the physics of it, it's not going to explode and wipe out a home. It could catch fire, and that would be bad. But people tend to notice when their phone is on fire, so it's probably not going to burn down too many houses. Samsung had that, right? They recovered. Sony had that. They recovered. They had fire phones. Anyway, so the point is, what's my worst case scenario for Apple? So Apple realistically 120, not 160. I mean, not zero. So it doesn't make sense for me to allocate as if they're going to zero. It's simpler, and obviously with some stocks, if you have any doubt at all, just err on the side of caution. But you look at these stocks and you say, well, I just don't see that happening. Coinbase and of course some of these we're self-hedging, right? So in Coinbase, we sold the 130 puts. They're actually below 130 right now, but we only sold 10 of them. But 10 of them obligates us to have $130,000. At the moment, we're down $3,700. We're down $10,000, $15,000. We might dump out of these puts. But look at how much money we're making on the rest of the trade. And why is that? Because we bought a bull call spread, 75 160 bull call spread, and we also sold the 150 short calls, and we sold them for $153,000. So if by the end of this year coin is below 150, we keep this $153,000. We only spent what is that, 70? We only spent about $70,000 on the spread, and we sold $153,000 worth of short calls against it. That's kooky, but that's what's great about options. Now, is there a risk? And again, is there a risk that it goes over 150? Oh, where's coin? Let's see that. Where's the chart? That's what we were worried about for a while, because we were worried it was going the other way and it was going to blow us out of the water. Here we go. COIN. All right, see, Coinbase actually was threatening to blow us out of the water. And in fact, we had lower puts and we rolled them to a higher put and so on and so forth. I mean, you can always make adjustments, and that's what we did. But still, even as it was going up, we said, you know what, 150 is as much as it should be, because it was all based on these ETFs being approved, and everybody thought coin was going to become the king of the world just because there are ETFs of Bitcoin. But that's not how coin works. Coin is itself an exchange, and the ETF in some way takes away revenues from coin. So people are trading on the ETF instead of trading through the coin exchange. That's a problem for them, right? So the same way that we don't think that there's an infinite risk to the bottom, we don't think there's an infinite risk to the top. And so we, on the whole, you know, we think coin should be in this range, about 100 to 100 and whatever. And we went into the stock mainly to sell short calls and puts against it, because that's where the money is, because people are paying so much premium for these short puts and short calls. So we said, well, shit, let's spend $70,000 for a long position that stops us from losing too much money if it does blow up on us. But meanwhile, we'll sell puts and calls for $200,000. And if it falls in between these two positions, we're going to make net what, 125 out of a $75,000 potential. And that's still, and we'd still have a year left to sell more puts and calls. So that's how we set up our positions. Here's Ford. What was the one I was talking? Oh, AT&T. What do we have for AT&T? So AT&T had their earnings today. Oh, we don't even have AT&T in the long-term portfolio. I did not realize that. Okay, so so as people have earnings, we look at them and say, wow. So AT&T today, maybe we should add that to the long-term portfolio. Oh, look how things are turning down. What a shame. NASDAQ's still at 1%, so who cares, right? With Yahoo. Now we can go over here. So AT&T, yeah, they're not down much. They're down 3%. But AT&T's down 3% today. They're mostly down, well, their guidance was not thrilling, but they're mostly down because even though they added 500,000 subscribers in the quarter, which is great, you know, when you consider how saturated they are on the market, they found 500,000 new subscribers anyway. Their PE ratio is 7, also stupidly low. They do have a shitload of debt, though. That's scary, but that's the nature of their business. Oh, that's also interesting. Like, people don't understand, like, you know, they look at the debt, which is, you know, staggering amounts of money, right? $132 billion. That's not Chinese money, that's American money. So they're $132 billion in debt. Now note that they were $157 billion in debt. They paid down $25 billion of it in a year because their cash flow is insane. They make $17 billion a year while servicing their debt. And you're buying the whole company for $122 billion. That's crazy. But people look at this number and they can't get their heads past it because it is a staggering amount of debt. But that's the way a telephone company works. Certain companies require infrastructure, like when they built the railroads, right? They had to first put down the tracks. First they had to buy the land. Then they had to lay down all the tracks and buy all the steel and so on and so forth. Then they had to build the locomotives, and then they had to build all the stations. And then they started collecting some money. Same thing for oil, right? You drill a huge hole in the ground, you buy the land, you drill some holes, then you put a gigantic structure on top of the hole to get the oil out of the ground. Then you have to have a crew, people maintaining it, so on and so forth. And then you start paying down your debt barrel by barrel as you're pumping it out of the ground. These are infrastructure investment companies. That's how they work. AT&T has to put up, they have to buy lands, just like it basically works the same way for all these guys, right? They have to buy the land. They have to put up towers. They have to connect all the towers. They have to build all the computing infrastructure inside it. They have to put stores all over the country and staff it with people who sell you the AT&T service. And then maybe they start making enough money to start paying it back. And anytime something changes, like they recently made a huge investment, starting around here, huge investments in 5G. So what they've done is they've spent this huge amount of money on 5G infrastructure now, and now they've got it. And for the next 10 years, they reap the benefit of having it already. But investors they no longer have the patience to have a simple plan that's like, okay, we spend this money now and then we make it back. Investors don't want to know about that. They only want companies that are making money now. And the second they stop making money, they want to get out. And it's a stupid way to invest. It really is. I mean, you could have a logic and say, oh, why should I suffer? It's like I'll just be there for the good parts, but you don't always know that you're timing it right. You're better off increasing your allocations and pumping up your reserves and riding out the waves, and sticking with it. Of course, obviously, the value is there, but right now it's 7 times earnings. This is just crazy. You are not overpaying for AT&T. See if we have any questions. Brendan says, my concern is an invasion or situation with Taiwan, and then we run into a situation like China telecom with Russian securities. Yes, I agree. That's the concern. That's why we stayed away from the Chinese stocks. Russians out of the question, of course. That's why we stayed away from the Chinese stocks. I don't see it happening. Hong Kong was different because it was like under contract that China was going to take it over, and it was under contract for decades. It was under contract for 100 years that China was going to take it over from the British. And it was bullshit. China said they were going to let them remain themselves and blah, and of course that was crap, and they absorbed them and put their own rules in and so on and so forth. But now they're kind of suffering for it. I don't think China is going to force the issue. I think what China is going to do is they're going to keep putting up candidates for election in Taiwan. I think they're going to just sort of, do a PR push and do whatever they can to get, until Taiwan, I don't want to say wants, because it won't really be wants. It's but they'll make it so Taiwan votes to be incorporated into China. That's their goal. They're not going to invade Taiwan and blockade it and go through and basically start World War III over this. That's highly unlikely. And that's the point. It's and even if it starts to happen, unless it's like that Red Dawn movie or something like that, and all of a sudden overnight China just invades and nobody had any idea what was going to happen, it's not really likely. We watch it like a hawk. All the other countries watch it like a hawk. The UN's on it, NATO's on it. I mean, it's not like they're going to suddenly show up and invade and take over Taiwan tomorrow. The way Russia, jumped into Ukraine and when nobody's paying attention. And even Russia, they went to, they took over Crimea, then they do this and then they do that. It's never immediate. But yeah, I mean, the day China invades Taiwan, I would be getting out of the Chinese stocks before it's obvious to everyone. We should be the first ones running away from that. But assuming it doesn't happen, which is the 90% probability, then these stocks are insanely undervalued. I mean, you don't get a bargain in a stock unless there's some sort of legitimate fear. It's not likely that you're getting a bargain like this on a stock, like AT&T. Well, that $130 billion worth of debt can bankrupt anybody. So you can't give in to the worst case scenario. And again, as I was saying though, also fairly small allocations in our long-term portfolio. We have zero China exposure. Now we have a little bit of China exposure. We can afford it, especially when the upside on two different trades is, I forget what the JD one is, but it's like $80,000 worth of upside. Yeah, it's a huge amount of upside for a very, very small amount of cash being put into play. So, the risk is worth the reward, or the reward is worth the risk, to put it that way. Andrew says, any thoughts on Ares Capital? Ask me in chat, because I have no thoughts on Ares Capital. I haven't looked at them. I don't pay attention. Ares Management or Ares Capital? I guess he assume you mean Ares Capital. So I don't know what the dividend is, but now they have a low PE. They have 11 billion 6 market cap. They make $1.2 billion. It's very nice. They do have $11 billion in debt against a $11 billion market cap. That makes me a little bit queasy. I mean, obviously they got the money to pay for it. Still not thrilled when somebody's got 10 times more debt than they do earnings. So we'd have to look into it and figure out what's good and bad about it. So I don't know them well enough to give you an off-the-cuff answer, but I'm happy to go run it down in chat and figure it out. Interesting. Look okay. And again, when I'm looking at a company like this kind of stuff is important though. It's like, look what did happen to them. At some point, people lost confidence. It dropped to 17. That's what I call risk. Although it's not severe, they're only at 20, so it's like 15% down. So yeah, if I look at that and I look at them and I say I could put something together, and we look at what were these guys? ARCC. Okay. So if we look up they're very thinly traded options. That's one thing I would take into account. But they're 20. The $20 calls are $1.30. That's not so bad. $20 puts at $2.50, $2.75 even for the last one. So if we bought the stock and sold the $20 puts and calls, we'd pick up like $3 or so. We'd probably net in for like $17, and that was the bottom. So that seems fair. And then they pay, this is without knowing anything about what they're actually doing. And their dividend is what, 9%? Well, that's pretty good then. Yeah. We don't actually we don't actually have a dividend portfolio anymore. Though we have an income portfolio, not a dividend portfolio. But I'm not sure. I think we've kind of given up on the idea of using up so much cash to buy stocks just for the dividend. But as a dividend play, sure, it's fine. Again, I don't know enough about the company though. I don't know what they hold or what they're doing. It says business development company acquisitions. This is not a REIT. Acquisition, recapitalization, mezzanine debt, restructurings, rescue finance. Now, the problem with this is that in a recession, they could take a pretty bad hit. So I definitely want to look into it and see how diversified they are and what they're actually doing. So they're basically doing risky loans, and that's how they make their money. So we shall see. I mean, it's worth looking at, though. It's an interesting company. But you got to be careful about what you're investing in. And again, risk reward. What is the risk? What's the downside? What can happen to them? And we'll have Shellbot take a look and we'll see what he says and get some other opinions and look up some articles. There's a whole bunch of stuff to do there. See, here's an article. Why Ares Capital is a no-brainer dividend stock. The whole thing there to read. Let's see. Ares Capital increases yet falls behind the market. What investors need to know. A must-watch for big dividends. Public offering. Unsecured notes. Yeah, so how much of those do they have outstanding? You want to know. A large drop in the general market, blah, blah, blah. Falls mid, okay. So apparently they've been out of favor, which is fine. I mean, there's nothing wrong with somebody who's out of favor as long as you understand exactly why they're out of favor and what and whether you're willing to take that risk that the market isn't. Just like the Chinese stocks. At this point, finally, after watching them for a very, very long time, we have decided that we're willing to go in. It finally hit a point. Whoop. I mean, we've been looking at Alibaba since the portfolios restarted for sure. They were in our old portfolios, but we didn't want to get back in because that was last May when we closed out our portfolios, or April, I think we closed out the portfolios. We restarted portfolios in May, but at 100-ish, we got out and we closed our portfolios. We didn't jump right back in, which was, sad then, but not sad now. But we didn't jump back in when they got back to 80. They went back to 100 again, so that was a nice run. But since then, it's been bad, 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 bad. That was our shorter term thing. And the time before we got into Alibaba, they were in the low range down here. They were definitely, P around 10 or something like that. Now it's 7. So probably they were below 100 when we got into them before. And when they got up, when they get up to a certain point, we get out. That's all there is to it. When it went down, we didn't consider 80 attractive enough at the time, but now we feel like it's kind of formed a bottom. And again, my worries of China collapsing hasn't happened. I've been worried about China collapsing for a couple of years. This real estate thing is a disaster, but just like you can see it, you can see in the US how it's a disaster, but it's such a slow move. It's like a glacier or like lava, like lava's coming and you're like, it just moves like it, not even like, it moves like a turtle speed. And so you're not exactly like fleeing from the lava. It's just like people have to go. You see people watching lava, they like step back and they watch it, then they step back and they watch it. That's what this is like. The real estate is collapsing. It's like the lava. It's going to burn your house. Your house is going to get engulfed by lava. There's nothing you can do about it, but it ain't going to happen very soon. It's going to take a long time before the lava actually takes all your stuff. That's in pictures I saw from Hawaii, where like people like moving out. Basically, they had like trucks and things. They're like taking the stuff out of their house, which is about to get hit by lava. And they've got, slow as movers are, they have all day to like get their stuff together and move out. So that's the kind of disaster real estate is, because it takes so long. Because you've got a building and you bought it for $10 billion. It's a lot. That'd be a big building. But anyway, so you got a building, you bought it for $10 billion, and it's 95% occupied, and you're collecting your rent, and you're paying your bills and all that, blah, 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 whatever. And you're making your mortgage payments to the bank. Now, the economy turns sour, and you drop to 85% occupied from 95% occupied. Now maybe you're breaking even and not making a profit. But then the economy gets worse and you go to 75% occupied. Now you're losing money. But how much money are you losing? How long are you going to sustain it? What's your reaction going to be? Can you refinance? So on and so forth. Are new tenants going to come in? You may take that. Now you have 25%. Now let's say you're losing 10% and you have 25% of your building is unoccupied. What if you give out rents at 60% below, 40% below the market price, and you fill your space back up? Well, now you've got 25% or 20% of your space at 40% off, so you're making 12%, and you're back up over the level where you break even on the building. So now you bought yourself a couple of more years. That's how this stuff works. It's a back and forth dynamic, and it takes forever. It's still collapsing. The real estate market is still collapsing. Nothing has changed. You're just juggling to try to keep yourself alive for a while. And then, even then though, you go bankrupt, your company goes bankrupt, you finally give up because your building is, now you're in the situation you are now, which is buildings are 30% unoccupied, but because of work from home, the 70% of the tenants are only using half of their space. So the people who have rents are only using half the space. That's where the crisis really is. It's rotting from the inside, because the people who have contracts with you don't need the space they have. Now, they may be able to pay the rent and they'll pay out that contract, but they are not going to roll that contract over to a new contract. And that's when it all starts falling apart. But that's next quarter, next year, whatever. It's not fast. It's like lava. It takes forever for the problem to actually hit your doorstep. So even when the original landlord goes broke, now the bank is stuck, but the bank lent me $10 billion 8 years ago. And I paid the bank back $1 billion a year. I was supposed to pay the bank $1 billion a year for 15 years, right? That was the term of the loan. So I'm going to pay them 50% more over that time. My tenants were paying me $1 billion a year. I had no problems. Now, 8 years later, I've paid the bank back $8 billion. The bank has gotten back 80% of their loan. I may have put down 20% as a security deposit on this thing too. Not a security, as a down payment on the building. So if I put down $2 billion and I paid them $8 billion, they're even. They've already gotten their money back. They don't have any profit, but they're even on the building. If they foreclose on the building and they sell the building for $4 billion, which is 60% below what I paid for it, they still make $4 billion. They've now, over the course of 8 years, have collected $8 billion from me. 20% down was $2 billion, so they collected 10 plus 4 is $14 billion. So they laid out $8 billion because they got the mortgage was a deposit. They laid out $8 billion, and I paid them back $12 billion between what I paid them over 8 years plus the foreclosure. That is not a great return for the bank. That's not what they expected. But nonetheless, they didn't lose money, and they sold the building. Now, the next person who buys the building can afford to rent it out for a lot less money. They don't owe the kind of mortgage that the previous owner owed. That's how the real estate market changes, and so that's why it's such a slow dynamic. And if it's an orderly transition, it's possible you can go through the whole cycle without too much damage being done. And property and rents go down and properties get cheaper. That whole thing can happen without the whole thing blowing up. But that would be called a very soft landing. That's probably not going to happen. Probably it's going to be a bit of a mess, and some companies will go bankrupt, some companies won't. That's what's happening in China now. Giant property companies are going bankrupt. But those bankrupt companies, depending on how solvent the banks are, they will flip the properties and give them to someone else. Now, the problem in China, though, is that there are whole cities that are empty. So these companies have built cities worth of empty properties that are not fillable, and so nobody wants it. That's when you got a problem. It's different to have a building in New York City. Somebody's going to move in there because it's freaking New York City. This is like a whole separate city that this company built for tens of billions of dollars that they said people were going to move to, but nobody actually did. Or the people who did put deposits down said, well, this place never filled up, and now we don't want to live here either. Anyway, all right, so that's where that is. And how are we doing? We're selling off more? Not so terrible, right? Still a little bit green, a little bit green, a little bit green. Anyway, all right, any more questions? 'Cause I'm sorry, I have to cut this short. I got a couple of things to do. Chinese New Year soon. Oh yeah, Chinese New Year is also always good for Alibaba. And also, it's always a time that the central bank puts liquidity into the market because there's a huge demand for money around the Chinese New Year, right? Everybody's traveling and spending and so on and so forth. So this is the time of year they usually put some liquidity in. My voice is going. So yeah, so I don't put too much. I don't think this is a cure-all. I think that we wanted to buy these stocks. We think it's a pretty good bottom. The government's willing to put in stimulus, so that makes it attractive. But I don't think it's a be-all and end-all for us. And I don't think all of China's problems are solved. But like I said, it could be a very, very slow resolution. And so it's also not a reason to panic out of the market. So we'll take advantage. We'll be a little early here, and hopefully it'll work itself out favorably. And if it doesn't, we'll say, okay, that was a failed experiment. We lose 5,000, 10,000, whatever. We took a shot. We tried. But I've been wanting to take that shot for 6 months, and finally it seems like a good time to give it a try. That's where we're at. All right. Sorry, my voice is about out, and plus I also have to get to something else soon, which I also have to talk for. This is so annoying. I tell you, I've just had this lingering sort of thing, and it's so easy to string my voice and lose it. Very annoying. Is there anything else that was important to talk about? China, obviously, very important. Our markets, the values, a stretch. I don't really think we're going to go much higher than this, but I didn't think we were going to go this high in the first place. We're 10% higher than I thought we should be. So we're right at the level where it's kind of hard to imagine how we can keep going up like this. Speaking of FinViz, let's take a look over here. See, these are these are organized by market cap. So even so, though, I mean, half of the space, that's what you go by, the space, right? So half the space is red. So half of the market cap is red, half of the market cap is green. So it's not a broad rally. I mean, you've got healthcare is very down for whatever reason now. Utilities not doing well, basic materials not doing well, real estate not doing well, that's obvious. Consumer not doing well, discretionary consumer, cyclical consumer not really well. Is anything doing well? These guys. So it's tech and financial. That's what's doing well. And the problem is, if the real estate falls apart, then the financials are going to fall apart. And that's going to leave us with what? Just tech? No, because if all this stuff falls apart, then people won't have money to spend on the tech. All right, so think about that. So we're going to keep being careful. We're going to keep up with our hedges. and we'll see what happens. But it's really all going to be about the earnings, and we'll do a big report on that next week. Next week we'll analyze the earnings so far because we'll have enough stocks to make it worthwhile. All right, so I'm sorry I had to cut this short, but we are going to cut it short, and we will pick up again on the stuff next week. All right, thanks guys, take care.